Welcome to UExcel, where you can learn new skills anytime and anywhere. Visit uexcel.com to explore our full course selection. This lesson is part of a larger course. Check the video description below for a link to the full course where you can enroll. If you enjoy our content, please like and subscribe. For your convenience, the course cover displayed on your screen provides the complete course title and lesson title. Let's proceed with the lesson. Lesson: Measuring and Managing Capital Requirements. Measuring and managing capital requirements is a fundamental aspect of risk management, particularly for financial institutions. Risk capital attribution, an integral part of this process, involves assigning capital to various business units or activities based on their risk profiles. This approach ensures that institutions hold sufficient capital to cover potential losses while optimizing their overall financial performance. Effective capital management not only safeguards the institution's stability, but also enhances its competitive edge by fostering efficient resource allocation. Capital requirements are determined based on the types and levels of risks that institutions face. These risks include credit risk, market risk, operational risk, and liquidity risk. Each type of risk requires a different approach to measurement and management. For instance, credit risk is typically quantified using models that estimate the probability of default and loss given default for various credit exposures. Market risk, on the other hand, is often assessed using value-at-risk models, which estimate the maximum potential loss over a given time horizon with a specific confidence level. Operational risk is measured through a combination of statistical models and scenario analysis, while liquidity risk management involves stress testing and liquidity coverage ratios. The Basel Accords, a set of international banking regulations developed by the Basel Committee on Banking Supervision, provide a comprehensive framework for measuring and managing capital requirements. Basel II, introduced in 2004, emphasized the need for banks to hold capital commensurate with their risk profiles by adopting an internal ratings-based approach for credit risk and advanced measurement approaches for operational risk. Basel III, implemented in response to the 2008 financial crisis, introduced stricter capital requirements and additional buffers to enhance the resilience of financial institutions. Risk capital attribution plays a crucial role in ensuring that capital is allocated efficiently across an institution's various business units. This process involves assigning capital to different activities based on their risk-adjusted returns. By doing so, institutions can identify which areas generate the highest returns relative to their risk exposure and allocate resources accordingly. This approach not only maximizes profitability, but also promotes a culture of risk awareness and accountability within the organization. One widely used method for risk capital attribution is the Risk-Adjusted Return on Capital framework. RAROC is a performance measurement tool that evaluates the profitability of a business unit or activity relative to the amount of risk it takes on. It is calculated by dividing the net income of the business unit by the economic capital allocated to it. Economic capital represents the amount of capital required to absorb potential losses and is typically determined using VAR or other risk-based models. By comparing the RAROC of different business units, institutions can make informed decisions about where to allocate capital to achieve the best risk-adjusted returns. Another important aspect of managing capital requirements is stress testing. Stress testing involves simulating adverse economic scenarios to assess the impact on an institution's capital position. This process helps identify vulnerabilities and ensures that the institution holds sufficient capital to withstand severe shocks. Stress tests are conducted regularly and cover a range of scenarios, including macroeconomic downturns, market dislocations, and operational failures. The results of stress tests inform capital planning and risk management strategies, enabling institutions to take proactive measures to strengthen their capital positions. The use of advanced analytics and technology has significantly enhanced the ability of institutions to measure and manage capital requirements. Data analytics, machine learning, and artificial intelligence are increasingly being used to improve risk assessment models and enhance the accuracy of capital attribution. For example, Machine learning algorithms can analyze vast amounts of data to identify patterns and correlations that traditional models may overlook. These technologies enable institutions to develop more sophisticated risk models and make more precise capital allocation decisions. Effective communication and transparency are also critical components of managing capital requirements. Institutions must clearly articulate their capital management strategies and risk profiles to stakeholders, including regulators, investors, and rating agencies. Transparent reporting of capital adequacy and risk exposures fosters confidence and trust, which are essential for maintaining a strong reputation and access to capital markets. Disclosure requirements, such as those mandated by Basel III, ensure that stakeholders have the information they need to assess the financial health and stability of institutions. In conclusion, measuring and managing capital requirements is a complex but essential aspect of risk management for financial institutions. By accurately assessing risk exposures and allocating capital accordingly, institutions can safeguard their stability, optimize their financial performance, and enhance their competitive position. The use of advanced risk measurement models, stress testing, and cutting-edge technology, combined with transparent communication and reporting, ensures that institutions are well prepared to navigate the challenges of an ever-evolving financial landscape. This concludes the lesson. We trust you found this video informative and engaging. To enroll in the complete course, please use the link provided in the description below. At UExcel, we are committed to your learning journey. Each course offers a certificate of completion, online support, and downloadable resource files to enhance your experience. If you found our content valuable, we invite you to like this video and subscribe to our channel. Thank you for joining us, and we look forward to supporting your continued pursuit of knowledge.